So you may have heard of something called an A-B split, and you may be wondering, what is that? Maybe your parents had a trust that split into two parts at their death, and you're wondering, why would they do that? Do I need something like that? So in this video, we're going to talk all about what an A-B split is and why you might not actually need it in your own estate plan. I do want to remind you, if you find this video helpful, I ask you to please hit that share button and share it with somebody else who you think would also find this useful. Okay, so here's the situation. You have a married couple, and then the first spouse dies. What happens to the money in a trust? They've set up a revocable trust. Does all the money go to the survivor? Well, I'd like to actually give you a history lesson that I also go over in my video on estate taxes. So I ask you to watch that video when you're done with this one. So really, the crux of the issue is the estate tax exemption used to be really low, and there was no way to transfer it between spouses. So it was kind of use it or lose it. And when I say low, I mean $600,000, $1 million of estate tax exemption. Anything over that gets taxed, and it was like at 55%. So it was quite punishing. All right. So there was a big incentive to do something called an A-B split. And what this does is at the first death, all the assets split into two separate subtrusts, the A trust and the B trust. So I think of it as the A trust is above ground, that's the survivor's trust, and the B trust is below ground, that's the deceased person's trust. Most people did this for estate tax protection because the B trust got funded with the deceased person's half, and the A trust got funded with the survivor's half. Now, there's something interesting that happened in around 2010, 2012. Obama actually passed a law that set the estate tax exemption permanently at $5 million per person, which was the highest that we'd ever seen it. And even more importantly, we got something called portability, which means you have the option to port or transfer the deceased person's unused exemption to the surviving spouse. So now the surviving spouse can get all the money and all of the estate tax protection. I actually talk about this in my video, Should I Simplify My Trust? But there's a second reason why people might do this A-B split. So the first reason, of course, is for estate tax protection, which we don't need as much now because the estate tax exemption is so high. Actually, this year, it's almost $13 million per person. In 2026, that's dropping down to about $6.5 million per person, but that's still a fairly large amount of money. Now, if you have a really large estate, like over $20 million, or when it drops over $12 million, then you may still want to do this A-B split. But the reason that I see most people doing an A-B split nowadays is for control purposes, because the B trust becomes irrevocable. You can't change it. So that makes it really beneficial if the deceased person wants to make sure that their half goes to their kids or wherever, or the charity that they choose, that the surviving spouse doesn't change it, doesn't say, oh, I want it to go to my kids or to my new hubby or to somebody else. So for control purposes, we find it super helpful. Now, I'd like to review a couple charts with you so you can kind of see how this allocation happens, because people ask me, well, how should I allocate my money between the two trusts? Let's say you have a spouse that recently died and you have an A-B split. How should this be done? So I wanted to use an example from one of my favorite families, the Simpsons. So let me show you this spreadsheet. Okay, so here you'll see that I've made a spreadsheet. We're pretending that unfortunately Grandpa Simpson died and Grandma Simpson is still alive, all right? And they have an A-B split in their trust. So their revocable trust says upon the first death, upon Grandpa's trust, half of the assets go to the A trust, and we're talking about community property assets here, and half of the assets go to the B trust. All right, so let's see, what do they own? Let's say that they own a house in Sunnyvale for about $1.5 million. They have a large bank account in cash, it's $500,000, and both of those are held in the Simpson Family Trust. So you really want to make sure everything's titled properly in the name of the trust. And to learn how to do that, I have a video on funding the trust, so you can always look at that. Then they also have a small bank account. Maybe that's where they had their direct deposits or something of $5,000. And that was just held in both of their names, Grandpa and Grandma jointly. And then they had a brokerage account at Schwab for $1.2 million, and that was held in the Simpson Family Trust. And then Grandpa had an IRA, a retirement account at Fidelity, $800,000, and he had named Grandma directly. Okay, so that's going to go directly to her. All right, so let's see. We have 5 assets. How are we going to allocate those? All right, so let me show you the slide of what I suggest and why.
Hey everyone, if you liked my mom's video, like and subscribe.
Okay, so first of all, keep in mind that the assets in the trust are supposed to be allocated 50-50, okay, the community property assets. If you have separate property assets, they might all go to the trust of the person whose property it is, okay? But we're assuming this is community property here in California. So we have the real property. Well, Grandma may want to sell that property, or she might want to get a mortgage on the property. She might want to refinance it. Now, given the current mortgage rates, she may not, but she might want to. She might want to pull out some equity. And it's much easier to do that when that's in the survivor's trust, which is a revocable trust, all right? So we've decided to put that house in the survivor's trust. Now, that means that eats up almost half of what she can put into her survivor's trust. So we're putting another $100,000 of cash from the Bank of America account there. So the rest of the trust assets are going to go into the bypass trust. But here's the thing, Grandma still gets all the income from the bypass trust during her lifetime. So she's still being taken care of from an income perspective. But the principal, she's only allowed to dip into the principal if she runs out of money in her survivor's trust, which could be the case here, okay? Sometimes people can split things, 50-50. They'll put half of the house in the survivor's trust and half in the bypass trust. We don't know. There's different reasons for doing this. We look at capital gains tax issues. We look at California property tax issues. We look at estate tax issues. And this is something that you often talk with your accountant as well. Usually the estate planning attorney will work with the accountant to work out which bucket, the A trust or the B trust, the survivor's trust or the bypass trust, which bucket should each asset be placed into? Now you will notice that there's a couple of assets that don't go into the survivor's trust or the bypass trust. Those go directly to Grandma. And Grandma says, why, thank you. She receives the IRA and she can receive it and roll it over, stretch it out over her lifetime. And she also receives the little bit of cash from the bank account because those just go directly to her. As long as something goes directly to you, as long as you're named as the beneficiary, it still avoids probate. So we're doing okay with that. Now, once you decide which assets are allocated into which subtrusts, we call these the A trust and the B trust, we call them subtrusts. You need to retitle those assets. So you work with your financial advisor at Schwab, for example, and you do a deed retitling the property into the survivor's trust. And also for the B trust, for the bypass trust, you need to get a separate tax ID number and file separate tax returns for the bypass trust. This is one reason why a lot of people don't want to do that AB allocation, because you can see this allocation between the trusts, it really takes some thought and thinking, okay, how much flexibility do we want to have? Things that go into the survivor's trust are a bit more flexible in how you can manage them than things that go into the bypass trust. Things that go into the bypass trust, by the way, don't get a second step up in the cost basis when the survivor dies. And you can watch my video on capital gains taxes to learn a bit more about that. If what I just said was Greek to you, please watch the capital gains tax video to learn about that. So once everything is funded, that is retitled into those two subtrusts, then you're done with the allocation. So you can see this does take some time and energy, but in some families, it really makes sense. And especially for older trusts, you find this happening a lot. And when Grandma dies, then we have to wrap up both the survivor's trust and the bypass trust. And I have a video on the trust administration process so you can see how that works too. So I hope that this video was helpful for you. I do ask if you like these videos, I ask that you hit the notification button so that you can be notified when we release these videos, which is typically every week on Monday. So thanks so much. And why don't you go see the trust administration video, and I'll see you over there.
Hello everyone. If you liked my mom's video, don't forget to like and subscribe. See you all next time.